Hello, TheoTraders. This is the nightly report for Tuesday, March 29th. Yes, this is a new voice you're hearing. My name is Doc Severson. So if you don't know who I am, here's my story in 30 seconds or less. This is me, and I'd like to say that I'm a poster child for Rogaine. I've been trading the financial markets for about 20 years, and I've specialized in options for the past 12 years of that. I'm a husband and a father of 3. So unlike Don's kids, all of mine have been out of diapers for a long time, and they're turning into great young adults. And this means that my wife and I are now empty nesters, so we're getting ready to sell this old girl and trade that lifestyle for one where the sun is actually visible for 12 months out of the year. So what am I going to bring to TheoTrade? First of all, I'm going to bring the fractal price action analysis that I do every day. So using price action, but using different time frames to understand how the puzzle pieces fit together. Secondly, I bring a very structured approach to options. Somewhat similar to Don, but somewhat different. And lastly, I'm also going to be bringing how neuroscience applies to trading performance. So if you've wondered why you do what you do, perhaps I'll have some answers for you. So with that, let's get to today's report. So when I was looking at this past weekend, and looking to see what we were going to be dealing with. This is a website called fidweek.econoday.com. And what I noticed was that there was a lot of these the bold names here. And anytime you see these bold names, that means you got Fed speak. And Fed speak is probably the number one risk in today's market. Oh, look at all these landmines. I mean, they're past the quiet period, right? So we're going to get pushed around, and we already saw today Janet Yellen coming out, and the market moved probably somewhere in the order of 20 handles on the S&Ps after she finished her prepared remarks. And I was listening to Bloomberg at the time, and no, I don't have a Bloomberg terminal either. And they were talking about how it was one of the most dovish statements that they had ever heard. Now, a lot of times when we get these Fed movements like this, that, where we move 20 handles on the day, by the nighttime or the next day, people all of a sudden start scratching their heads and going, uh-oh, if she's that dovish, does she know something that we don't? That she's prepared to, unload the bazooka like Draghi? So what we find is that a lot of times these Fed moves, or moves that have been initiated based on Fed speak, don't really sustain very much at all. Although I think there's a good chance we may just sort of flatten out until we get to this big boy over here, which is the jobs report on Friday morning. So again, we had the same kind of thing happening at the beginning of March. I believe it was March 4th we had that report, and we blew it out of the water, right? But the market had already priced in a fairly good report. But we might be starting to get into the situation where good news is bad news, right? So if we start to see the employment report getting a little hot, what that means is that Janet Yellen is going to be on the block with rate hikes. Now, speaking of that, this is the FedWatch tool. If you Google probability of Fed raising rates, or you'll get to this site, which is the cmegroup.com FedWatch. And for the April meeting of the Fed, which is about a month from now, this probability of the rate hike happening in April went from 12% yesterday down to less than 7% today. So basically, this is a big fat zero. We're not going to have any rate hikes happening in April. So the next big possibility would then be June. Typically, a lot of the intermediate Fed meetings where we don't have the presser afterwards. So I'm talking about the big meetings like March, June, September, December. Those are typically going to be the meetings where we can anticipate some type of action if they're going to do anything. So back to the charts here. Across the board, we had a pretty strong move here. So from the dip over the last couple of days on the S&Ps, we have come up to recent highs, although I guess what I'm looking for on this is that since we dropped from this day, which was at the very end of December, this is really where the drop happened from. So we went all the way down. Once we got past especially the round number of 2000 on the S&Ps. I have been looking for this to retest this kind of launching point for that. So I'd be surprised if we don't eventually inch up to that point in the next few days. What we're starting to see is this sort of very reminiscent of quiet and trending bull market action, where we see breakout, sideways, breakout, sideways, breakout, sideways. So this is almost the stair-stepping price action that we were used to seeing in 2012, 2013, 2014. This type of stuff where we're going flying around the place, just bang, 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 bang. All right, this is the signature of corrective markets. So if you want to look at a signature for corrective markets, look at the end of 2007, so the back half of 2007, and then how it started releasing to the downside in 2008. We've started that process now. However, if, and this is a big if, the price action is able to maintain this type of character where we start to, the volatility just leaches out of this and that we just keep pressing to the upside. Okay, and if we just keep on doing this, you're going to see the VIX go down into single digits again before long if we're able to do something like that. So you'll see some very defined signatures if this important level is broken through and we take on that character of quiet and trending markets again. If we do not, if the volatility maintains, then the next destination is going to be down here. Okay, so that's the S&P, and let's look really quickly at the Russell. The Russell had a strong day, but it still has a lot of obstacles overhead. So right now, just because we've rallied strong off of the Russell, this is nothing more than a larger time frame lower high. I'll explain what that means in just a minute. Looking at the NQ, seeing kind of the same thing. The NQ has actually been sort of lagging compared to other indices. Perhaps it's because it spent so much time leading over the last few years that it's kind of tired. Here's our flight to safety here. The Dow has actually stayed fairly strong. Look how close we are to all-time highs on the Dow. So the Dow has never fully approached the bear market status of 20% from the highs, but we have seen the Dow go into a monthly downtrend. So again, if that starts to move in a very quiet, stealth fashion to the upside, then we can be canceling out that monthly downtrend without too much effort here. Again, we're at a huge inflection point pretty soon here in the markets. I just want to spend a couple of minutes on something here which is going to lay the groundwork for some of the work that I'm going to be doing going forward with TheoTrade. One of the things that I've heard recently, and this goes towards, I'll show this in crude oil, and I'll also show this concept in gold, or at least the GLD ETF. So in crude oil, we've made a move from 26 up to, I believe it's somewhere like 42.5. That is a 43% move off of the bottom. 43% move off of here, okay? That's pretty significant. And so I've heard a lot of people saying, hey, 43% move, that's a new bull market happening. Well, wait a minute. Let's get some perspective on something here. This is just a 1 year chart. This is just a typical daily chart. And this is what 98% of people focus on only, is just the daily chart. So their entire world comes and goes depending on what's happening with the daily chart. But let's do this. Let's apply a fractal series to this daily chart. So what we're going to do is basically, I don't want to go into this too much here. We'll be here all night, but we have the monthly chart, the weekly chart, and the daily chart. And these are separated by about a factor of 5. Okay, so monthly chart, weekly chart, daily chart, kind of a factor of 5 in between them. And so here's this 43% move, okay? But in the perspective of the weekly chart, all it is clearly just setting up for the next lower high. Here's the monthly chart. It's just a blip in a huge bear market going on right now in crude oil. So with a monthly downtrend with a lower high and a lower low. So a lot of times it really helps to have perspective on what's going on. If you only focus on the daily chart, you're going to lose the larger perspective. You're going to lose the context for what's happening on these parent time frames, which are much stronger and have much greater influence on what's happening with the price. Okay, so let's do the same thing with gold, or in this case, the GLD ETF. So it's a good approximation. Now, if you're just looking at the daily chart, and if you're looking just at the daily chart since last fall, you're seeing this move here, which is a glorious 22% bull market. And you're going, hey, the bear market's over. It's a bull market now in gold. And I've heard a lot of people talking about this and going long on GLD or gold or anything like that. Well, let's look at the perspective from the weekly and the monthly chart over here. Weekly chart, this is clearly setting up for the next probable lower high. And then on the monthly chart, again, nice little bounce here, but again, in the greater context of what's going on here, this is a monthly downtrend, and monthly downtrends do not reverse instantly. It's kind of like an aircraft carrier out in the Pacific Ocean going at flank speed and all of a sudden asking it to pull a 180. It's not going to happen. It's going to take miles and miles of real estate to get that dude heeled over and back in the other direction. So I'm going to close out with that being my point today, is I want you to start looking at the different time frames of charts. If you're going to use charts to trade from, to get edge from, then you've got to have the context of what's happening at the larger time frames. Now, there's all kinds of rules that we can go over for these. I've got two major ones, which I'll be talking about later on this week. But for right now, if you are spending most of your time, or the majority of your time, staring at a daily chart and wondering why things are happening that seem to be beyond your control, very likely it's because you're losing the context of what's going on at the larger time frames. Thanks for listening, Theo Traders. It's an honor to be here, and I'll look forward to talking with you soon. Take care.